most people are taught to use their money to chase net worth.
Why is diversity bad? I mean, that's what everyone tells, right? You know, don't put all your eggs in one basket.
What if you have $2 million in it,
Yeah.
but it's creating stress?
How is that worse than having cash flow?
Like some people think in real estate's the asset. The house doesn't write checks.
The main idea behind cash flow is
it's our human life value that matters more than our property value. We spent tens of thousands, and then it led to millions.
And you're saying that difference would be
cash flows like blood. You can have some atrophy with muscle and be okay, but if you don't have blood flow, you die.
Okay, Garrett, how's the day been going?
Man, it's been a good day because I just had a call with one of the biggest companies in the insurance business, and they approved all of my What Would the Rockells Do content for the licensing, want me to do a bunch of speaking, and help me get to my 100 licensees this year.
Dude, that's awesome. We want to come back and talk about that a little bit, about how you got to that process. And I think that kind of segues into a question that's been asked a lot on the channel, has been around what is cash flow? So I want to dive into that. What is cash flow? How do you define cash flow, and why is it important?
We're looking at our income over expenses.
Yeah.
Okay. So to give it context, our balance sheet, which is our assets versus liabilities, that tells us what our net worth is. Okay. So that's cash, but it's not exactly cash with our net worth, because we might have, like, one of the assets might be a home, another one might be a 401k, another asset may be a business, or a car, even though it's depreciating. And then the liabilities are if there's loans against that, or taxes against that, or fees, or just ongoing expenses. So when we have more assets and liabilities, we call that net worth. And I'm here to say that net worth isn't the most critical factor. It's just a snapshot in time that's somewhat useful to tell us about our trends. But it's really a function of what happens to our cash. If we look at, like, our assets, hopefully create income. Sometimes people have assets that don't create income. That's what I would call a lazy asset.
So, for example,
equity in your home. My parents have a lot of equity in their home, but they're, in their 70s, and that doesn't provide any cash for them.
Gotcha.
Right? But like a business, like, I have a program called Multiplier, and people are paying, $250 to $500 per month into that. That's actually, now I have all the asset of my intellectual property turning into income.
Gotcha.
So cash flow is, can you create income from your assets, whether that asset is, your ability to go out there and produce value, or a specific asset that's actually creating that income. And cash flows are income over our expenses. So it's either going to be positive or negative cash flow if we have more income than expenses, because that income is something that's happening, on a monthly basis. And then that expense is, where it tells us what our net income is, right? It's the net. And so there's a lot of things in finance that overemphasize our net worth, overemphasize the balance sheet, but don't look at the income statement. And that's why a lot of people aren't prepared when they get to retirement, because now all of a sudden in retirement, they may have done a great job with their balance sheet, let's say. Okay. So maybe they've got a $2 million home and they owe nothing against it. Awesome.
Yeah.
Then let's say, even again, that they have a $2 million IRA or 401k. Let's just say it's a traditional, so they still they haven't paid tax on it. So they have a potential liability, right? That potential liability would be what tax they might pay.
Gotcha, because when they take out their 401k.
Right, because if they pull it all out in that year, then they're going to be the highest tax rate because of that much money. So that liability would be whatever the tax might be. And the other liability is also kind of, if we look underneath, is all of this is kind of what's happening on a spreadsheet. But what creates that? This is property value up here, but beneath it is human life value. So what if you have this great 401k that's, got $2 million in it?
Yeah.
But it's creating stress. That's a human life value liability. What?
Stress because of it's volatile with the stock market.
Yeah, the market's going down, or now that you have to create cash flow with it, you've never really done that before. And when you go to take that money out, you hope there's going to be enough. So it's like, okay, there's the stress of that uncertainty,
Yeah.
right? Stress of scarcity, fear, uncertainty, lack of control, right? Economy, like all of that kind of stuff. That's a liability.
Yeah.
There's the tax liability, which is an actual measured one, but then there's the things that are harder to measure that are actually the most important thing, because it's our human life value that matters more than our property value. It's our thoughts, our ideas, our emotions, everything that make us intrinsically valuable is our human life value. Property value is just how we organize our human life value to create something that we could utilize and enjoy and benefit from. But by the way, if we never benefit from it, some people think a house is an asset, but a house is only an asset if it's being utilized. Like some people think in real estate's the asset, but it's actually the tenant when you're that pays you. The house doesn't write checks. The tenant does.
Yeah.
And so we have to get to like, where's value come from? How does value sustain? And what kind of investor are we? And if we don't understand what we're investing in, it's going to create this human life value liability. So here's an example. So if you grow your assets, let's say, right? The assets increase in value. You start going up in value. But your knowledge around finances and what you're doing remains the same, you're going to see there's a gap in it. Like I knew someone that at one time had 80,000 Bitcoin.
Dang.
Okay. They mined it in the early days, but they sold it long before it was even worth $1.
Yeah.
See, so they had this growth in an asset without the knowledge of what the asset was. And so that created this risk. So what happens is sometimes when people get even more money, they get more fear because they don't know, is it going to sustain? And what if people want it? What if they get sued? How do they maintain it? Where should they be investing? So it's really, you've got to get to a place where you're increasing your financial intelligence so you could be a steward to handle this. So you want your knowledge to also increase with your assets so that you can continue to have them, so that it isn't confiscated by tax or confiscated by reckless investing or not knowing how to mitigate the risk. And so, yeah, your first question was cash flow. But it starts with like knowing who we are and our human life value. So our human life value is all of our skills and our what I might call mental capital or knowledge and wisdom. It's even like our relationships. There's so much that go into our human life value. But if we don't take and look at our assets and say, how do we create cash flow with those? What it really is just unrealized potential.
So with that, you're saying that our property asset should align with our human life asset?
I'm saying that if you end up inheriting a bunch of money or winning a lottery and you didn't have the skills and the knowledge of what to do with that, it will destroy you.
Yeah.
You'll end up bankrupt, in jail, or in fear. And so, yeah, we have to grow ourselves. If we don't have this knowledge, it's unsustainable. It's why when people are trying to create a legacy, but they don't invest in their heirs and they don't know that the money's coming or what to do about it, and they haven't defined it within their estate plan, all of a sudden that could destroy them. Gotcha. They could end up blowing that money because it's like going to the gym and not being strong enough to lift a weight and trying to lift it without a spotter. You can have a spotter that helps you along the way, but you eventually have to develop that financial strength.
Yeah.
And so really the game is, how can you get your assets to be more productive so they create income? And how do you manage your liabilities so that your expenses don't eat you alive? So some liabilities and expenses are destructive. We want to get rid of those. Some are just lifestyle. So they're just things that we purchase and we want to pay cash for those. Some are protective, that says, how do we make sure that we shield ourselves from risk and protect our assets from financial predators? But then there's also productive expenses. So what would be a productive expense? Might be, hey, Wes and I've hired you. Mm-hmm. So that shows up as an expense here, right?
Yeah.
But with your insights and your ability, it can help me increase my income. Yeah. So even though it would be listed on the income statement as an expense, whatever I'm paying you every other week or whatever I'm paying you every month, we also have to look at what capabilities I personally gain.
Yeah.
How does that potentially increase my human life value? How does that potentially help me have new insights and new skill sets and new abilities? Like we were driving up here and we're talking about how Dan Martell was showing me how to figure out which videos to do. And we listen to that for like 10 minutes and you're like, oh, that makes sense, right? We paid to get access to that knowledge so we could do things differently. And a lot of people, they are really accustomed to paying for education formally in school. But not as many people are as accustomed to looking at it as a lifelong process. I feel like entrepreneurs are more likely to do that, being in masterminds or having a coach or a mentor. I mean, even people in sports, almost all of them have nutritionists and coaches and mentors and, you know, even mindset coaches like sports psychologists. You know, I've seen that over and over. So it's really about, we've got to develop ourselves and we've got to develop our assets. If our assets don't create cash flow, then what good is it?
Yeah. Well, and it's an interesting concept because like what's the average tuition for college, for like a semester of college? You know, anywhere from like 10 to 20 grand.
Yep.
Right.
Yep.
And it's like, what, you know, from your experience, what knowledge could you gain from taking that 10 or 20 grand and just hiring a mentor?
Yeah. So back when I was in my early 20s, I joined Strategic Coach. And I believe that first year I only paid $7,500. Okay, so less than the $10,000. So we could even say, all right, I still have some money left over. In my early 20s, I also did landmark education, and the forum was less than $1,000. The advanced course was less than $1,000. So all in, I was able to take 2 landmark education courses, a full year of Strategic Coach, for less than $10,000. Mm-hmm. Now, in Strategic Coach, I figured out top 20 relationships I wanted to develop, top 20 relationships that I wanted to continue. I went through in my pocket planner and thought, what are the big projects that are going on this quarter? What are the things and people that I need to have access to in order to achieve those? I took a whole day to just think, and I got coached. And, you know, I didn't know a lot about business. I mean, I had a car detailing business when I was 15, but then I started in finance. And I was pretty good at sales, and I was pretty good at, you know, just growing that in a container that was within an organization. But then I wanted to take it and make it bigger and have my own business and be kind of in a place where I was creating intellectual property. And Dan Sullivan's one of the best at creating intellectual property in the world. So I joined Strategic Coach, and I learned so much about business that I was never taught in school. Mm-hmm. And when my business partners died, it was probably the thing that helped save the business to get through because of the things I learned from Strategic Coach. I know it helped my marriage because, you know, Babs, who's the president of Strategic Coach, had me take more free days. And I thought it was just work. But by being refreshed, that helped me out. And then Landmark Education helped me to create more possibility and speak vision into existence and understand what was holding me back from the past. And so just those 2 things, the only semester in school that would even compete with that was Stephen Harrop being my professor, who managed $5 billion in municipal bond funds, but then donating our class, he gave us $250,000 that we could then take and invest that $250,000 as a class and have benchmarks against that. And there was like 5 groups that each had their 50 Gs. And then, you know, you got graded based upon how that went. Yeah. So we learned a ton from that. And I went out and worked out with him. But my general education classes, I learned things that are not even valid in today's world. I learned about the food pyramid in the nutrition class. That is garbage, you know? I don't remember a lot of the other general education because it was just about going through the motions and getting the grade. It wasn't custom to what I was doing in my life and in my world. So I just find that there's such a valuable tuition outside of the classroom. And that's where, you know, I was able to increase my ability to create value.
Yeah. So going back to cash flow, I think one element that I hear a lot is, you know, what's the difference between cash and cash flow? So if I have $10,000 and I put it under my pillow, how is that worse than having cash flow?
Okay, so let's look at, this is what cash is like. We live in Salt Lake City, okay? And right by Salt Lake is the Great Salt Lake, right? It's just this one living organism, right? That's it. So much salt you could float. There's no houses around it because nobody wants to live by this smelly, dead, stinky lake, right?
Yeah, it's got a special smell.
It's got a special smell. So like if that were, if there was rivers coming into that and there was flow to it, then there'd probably be a whole different landscape in Salt Lake. But on the other hand, if let's go to the Amazon, okay? In the Amazon, there's this river, the Amazon River, and it's so powerful that it's pushing fresh water into the ocean for miles. There's so many trees and life all around this, right? There's snakes, there's birds, you name it. It's lush.
Yeah.
It's just flowing because it's going. So like, think of net worth as still being valuable. It's almost like in the body. Net worth is like muscle, but cash flow is like blood.
Gotcha.
And you could have some atrophy with muscle and be okay, but if you don't have blood flow, you die.
Yeah.
So cash flow is the bloodline in our finances. It's money that's coming in regularly and consistently versus one time. Cash is you get a lump sum and you go, now I have this cash, what do I do with it?
Yeah.
And if it's accumulating, it's not creating cash flow. See, cash flow can help you create something called financial independence. And financial independence is when you have enough recurring revenue from your assets. So let's say that you own some real estate, or like me, you've got books, right? And that those things kick off on a monthly basis, recurring revenue. And that recurring revenue is also known as cash flow.
Uh-huh.
And so entrepreneurs are intimately familiar with cash flow because even if you have big lump sums of money, what happens from month to month when the bills are due, when there's payroll? It's cash flow that helps that. And if that's monthly recurring revenue, otherwise known as MRR, that's a great place because now you have stability. Like when you know that money's going to be there, then, like when we're financially independent, my wife's like, hey, if you want to do something, that sounds great, even if it's going to take longer and be more expensive than we initially think, because we have this cash that we can count on. So cash flow becomes this consistency so you can swing for the fences on other things that you're doing. But if that cash flow is not there, everything goes to how do you make the next payment? And so many people are trained to neglect cash flow. They're just trained instead to accumulate.
Yeah.
Right? So accumulate is you make money, you take a percentage of that money, and you put it away. And so that money then grows in one account. And then when you retire, now you're supposed to take that money and create cash flow. But you didn't learn how to create cash flow for 30 years. So it's like never going to the gym, never training, and now all of a sudden you're supposed to be great at being strong in the gym.
Yeah.
And so Weston, where it gets really scary is when there is no cash flow again. And even if someone has a lump sum of money, like $2 million, right, in some account, and now they got to create cash flow, they've got these three enemies. First one is interest rates. If interest rates change, it can drastically impact that cash flow. So here's an example. If someone retired in the year 2022, and at that point, they might have had a bond paying 2.5%. Okay, that bond portfolio might be a bunch of them. And now all of a sudden, the Federal Reserve says we are going to increase interest rates and we're going to go to 5%. Okay? So, okay, when you're retired at $2 million at 2.5%, that's not very exciting.
Yeah.
That's $50,000 off of $2 million. Taxable. Not exciting. Here's the problem. When it goes to 5%, that's better. But if you already own the $2 million at 2.5%, when it goes to 5%, guess what?
You're stuck.
You've actually got to sell your $2 million for less because you've got to sell it where it would be kicking off 5%. But remember, you only bought them for 2.5%.
Yeah.
So I don't know if you ever heard where it talks about bonds have an inverse relationship with interest rates. So what that means is if interest rates go up, bond values go down, right? Now, if bond values go up, it's because interest rates have gone down. Because again, imagine that I've got that $2 million earning 5%, which is great because now that's $100,000 coming in instead of $50,000. and they go, you know what? We're going to do an interest rate decrease. The Fed announces, and you're like, oh, it's at 2.5%. Why that's good news for you is you're basically selling a 5% or $100,000 cash flowing asset, and people could only go out there and get a $50,000 cash flowing asset with the same money.
Yeah.
So you can sell it for more than $2 million.
Oh, because of its potential.
Well, because they know that that's what they know that they could get, a lot more.
Yeah.
They get double the return with this higher interest rate. But the reason why, if you're starting low and interest rates go up, you have to sell for less is because you have to compete with the new bonds that are paying more than what you were getting paid.
Gotcha.
Which means you take a hit. And so the problem is most people are just trained to diversify, accumulate, and wait.
Yeah. Why is diversity bad? I mean, that's what everyone tells, right? Don't put all your eggs in one basket. Diversify.
Because what we have to focus on is our skills that matter.
Mm.
And so if someone's like, diversify, and I'm like, well, I want to learn to be a better real estate investor. I want to learn how to buy businesses. I want to learn how to trade stocks. I want to learn, the more we add, that's when we get diversified.
Yeah.
Because we don't get good at any one skill.
Mm-hmm.
And we never master anything, so we're mediocre when we don't master those things. And so when we're just handing our money over to someone else, right? When we're just handing that over, yeah, I get why people diversify, because they're like, well, what if this one stock decreases and this other stock increases? Because they're different categories, maybe. Maybe this is in one sector and this is in another. So they're not totally related. But guess what? Most people just are overly reliant on the stock market.
Yeah.
They put the majority of their money in the stock market. And so they might think they're diversified, but they've got multiple mutual funds holding the same category of stocks or the same kind of sectors. And so they think they're diversified, but the entire stock market often, if there's a recession, the whole stock market suffers. Now, ironically, I guess, is over the last few years, it's been just 10 stocks or less driving most of the value in the market. So when I'm talking about why diversification is not helpful is if you lose focus. If you get involved in too many things, you get distracted. Mm-hmm. You can't manage it, right? It's mismanaged because how would you know how all of this would work? There's actually more opportunities to lose. Why? Because if I've got 10 things instead of one thing, okay, there's more, but they're saying, well, yeah, but some might make and some might lose. But if we're talking about your skills in your business, simplification and focus equal wealth. Complication destroys it.
Yeah. So as
scattered, yeah.
So as an example, I think a lot of people would be like, "Oh, Warren Buffett, he diversifies."
Not really. So let's talk about Warren Buffett. So first off, Warren Buffett is not a stock market investor. Not in the sense that everyone else is. So he's not owning mutual funds. Okay? He's not buying a company as a mere minority that gets no voting rights.
Yeah.
The main thing that Warren's doing in the stock market, the main thing is he's in acquisition. Some people might have acquisition for private companies and small companies. Like we work with a lot of dentists that buy other dental practices and they become a DSO, dental service organization. But he's in the game of acquisition. And when he buys a stock, most of the time he buys the company.
Through the stock.
Yeah, now he's owned Apple stock. He's not, that doesn't mean that he owns Apple because he's a minority there. But most of the time he's acquiring a company. Mm. And when he acquires the company, it's just that he has so much money that he's buying public companies quite often.
Yeah. So
if you bought a stock, Weston, or I bought a stock, this is how much management control we have. 0, yeah. Right? When he buys the company, they actually have the Warren Buffett way. They come in and they go, is there things that we absolutely can create more output with what we have? Can we let go of people because it's inefficient And then all of a sudden, we're going to actually drive the stock price up. He's got an entire methodology that's fairly ruthless, really, even though he's very happy-go-lucky sounding kind of guy. But it's not the same game as someone that's buying mutual fund inside of a 401k.
Yeah. So he's not necessarily diversifying because he's basically doing the same process with new assets.
He said no to the internet in the late 90s. He goes, I don't get it. I'm not investing there. He didn't invest there.
Yeah.
He's bought companies off a page-and-a-half letter because he could understand what the company is about. He's buying based upon his investor DNA.
Yeah.
So he's really good at allocating capital. But he allocates capital based upon fundamentals. Other people allocate capital. Like when I think of Facebook buying Instagram, like they just saw the trend and they bought a company for over $1 billion that had only been around. Do you remember how long that was around? Like 18 months or something?
Yeah.
It was but they saw the trend.
Mm-hmm.
Warren's not going to go invest in something that doesn't have fundamentals because of a trend. He wants the fundamentals and then adds those other aspects into it. So it's a very different thing. He kind of has this analogy where he talks about Ted Williams. And Ted Williams, he batted over 400 in a season. And part of the reason is, let's say that this box is kind of the strike zone. Ted Williams only would swing at pitches within his zone of genius.
Uh-huh.
Like he just felt like if a pitch came into anywhere in here, he had a very high likelihood, if it's over here, even though it's a strike, he'd rather take it. He's waiting, and Warren Buffett felt the same way. He's like, there's tons of stocks that he passed up on and companies that he didn't buy because he only wanted to swing where he knew he had the right investor DNA.
Yeah.
And so he knows what pitches not to swing at, which is what really makes him a great investor.
Yeah. Whereas most people would be like, oh my gosh, you missed out investing on the internet. You missed out on a huge opportunity. But obviously Warren has not.
Yeah,
He's made millions.
See, Warren created economic independence very early on. And part of it's because he's just so frugal. I don't think independence.
Yeah, it's okay.
Yeah. So anyway, forget about how that's spelled. But economic independence is when you have assets, and those assets create enough cash flow to cover expenses. See, if I had $10 million, but I didn't know where to invest it, that might get me, and in today's world, it might not be too bad. I could get $500,000 on that, just in a treasury. But back in the day, it might have been a whole lot less. Now, on the other hand, what if I had something and I was only worth $7 million, but it was kicking off $1,100,000 per year? So this would be the question. Would you rather have 10 million or 7 million? Well, if that's just the only question, 10 or 7, I'll take 10.
Uh-huh.
But what if you now have to ask, would you rather have $500,000 of cash flow or $1.1 million of cash flow? See, because this cash flow, if that's annual, it doesn't take long
to surpass,
to catch up, right? You basically have $600,000 per year. So that's 1.2, 2.4. We're talking not that much longer than 5 years. You're actually better off having the cash flow than the higher net worth.
Yeah.
And because most people are taught to chase net worth, use their money to chase net worth, allocate it by reducing expenses, by automating into, a 401k or something like that. And usually try to save 10% of your income, reduce your expenses to do it, and then just wait, and then just hope. Maybe you'll get there.
Yeah.
Have your money accumulate to create net worth. I'm like, well, what if you had your money and your focus was cash flow? So the first thing I would tell people to do, number one, is why don't we just find ways to be efficient?
Such as?
Okay, so let's look at the 4 biggest ways to be efficient. Number one is most people overpay their taxes. If you are a business owner, it's highly likely you are, because you might have a historian telling you how much you owe versus a strategist helping you navigate through. right? And there's ways to classify your income that can make your taxes lower, how you take your salary, what type of corporation you choose, you know, all that kind of stuff. The second one is interest. So there's really 3 R's that help you with interest. First one is to restructure loans. So that could just be refinancing a home, refinancing a car to pay off higher interest rate loans or to bundle them in. The second could be renegotiate. And when you renegotiate, you might say you have a credit card with a high interest rate. You could say, I'm going to balance transfer or cancel, and they'll move you to the retention department and you get a better interest rate. Or just reallocate.
Because they would rather keep you paying interest to them even if it's less.
Especially if you have a good credit score and you've been paying on time.
Yeah.
Because it's expensive to acquire a new customer. It's easier to keep one. So reallocation, it's just maybe you have a lower interest rate loan, or you have a high interest rate loan, okay, let's say, on your loan. But in your investments, you have a lower interest rate. So imagine this. Imagine you have a 6% loan, but you're only getting 3% on your money. By the way, paying that off is 100% return of savings.
Oh, gotcha.
Because if I buy something for $3 and I sell it for $6, that's 100% markup, right?
Yeah.
So this is just saying I can get 100% savings going from 3% to 6%.
So in that case, you're saying it'd be better to take what you have earning interest and instead pay off the loan.
Yeah, that's going to free up your cash flow, right? That's
Yeah.
good. So there's one way you can improve your cash flow is you could lower your expenses.
Yeah.
Another way is you could improve your efficiency. And another way is you could be more productive. Okay, so the third one on the efficiency is investments. There's just a lot of hidden fees, non-performing fees that some people don't think is a big deal. But this is why it's a big deal. If you have $100,000 earning 10% over 30 years, $1,740,000. That's pretty amazing. Same $100,000, but you only earn 9.2% over 30 years. $1,400,000. That's a big difference, and the big difference is because there's also compounding. You know, you get algorithmic returns. It's compounding returns. There's a big difference between 9.2 and 10.
And you're saying that difference would be hidden in the fees.
It's just, imagine if this like 0.8%, you know, was expense ratios that didn't actually help. Expense ratio is what pays the fund manager, but maybe an index fund would do better. Maybe there are 12B1 fees. 12B1 fees are marketing fees that you pay. There's also, if it's inside of a retirement plan, there could be legal fees, custodial fees, you know.
And so
admin fees.
What can you do? I mean,
well, like one, you could just be in an index fund.
Oh, gotcha. So switch
and
the structure.
two, you could go to a flat fee, low cost, you know, self-directed IRA instead of a managed one. So,
Gotcha.
Those are a couple examples. And then the fourth one is insurance. There's just a lot of people that are overpaying on insurance because they didn't design it properly. You know, you could be a car and home and have different companies bring them together, multi-policy discount. Raise your deductibles where you feel comfortable, where you just pay cash out of your pocket, and then lower your premiums by doing that, you know, because if you make claims, they're just going to raise your premiums anyway. So there's a lot bigger ones than that, but those are just, you know, those are the 3 big ones here as far as tax, interest, investment, and insurance, that you just become efficient, which is going to help you have more cash flow. So you could pay things off, and that would improve your cash flow. Or you could plug financial leaks out to improve your cash flow, or you become more productive. So there's a few ways to be more productive. So let's just say that we have that balance sheet again, our assets versus our liabilities. And for example, maybe you've got $1 million in a SEP IRA, right?
Yeah.
And the problem is you're like, ooh, I can let that grow and there won't be any tax. And if I pull that out, there would be a 10% penalty plus tax. So people hate penalties, so they'll just leave it in there. Well, it's not creating cash flow. It's not helping you on your path to economic independence, right? And that's our income versus our expenses. We want our assets to create more income, and we want to manage our liabilities so that they create expenses, but the most productive ones possible instead of just money leaving our pocket. So here's the deal. Most people, the way that they build their balance sheet is exactly the opposite and backwards. Okay? So the way they build it is they look at their job or they look at their business, right? And they go, how can I take my income to build some assets? And they try to take 10% of that and put it into some type of retirement plan. Okay? So put qualified plan.
Gotcha. So income creating assets.
So how are they going to get the 10%? By reducing expenses. But what happens if those would have been productive expenses? What if they took that money and they did strategic coach, like I talked about?
Gotcha. And then they can increase their income.
My multiplier program.
Gotcha.
Right? So all of a sudden they're taking, and that's increasing their expense. And so temporarily, there's less money to go in the qualified plan. So they're thinking, no, I got to reduce my expenses so I can have more money to put in my qualified plan. But the problem is the more they reduce expenses and liabilities, the less access they have to people, to mentors, to a financial team. Like, what if they're so cheap that they're like, I'm going to do my taxes myself. And because they do their taxes themselves, they overpay their taxes by $100,000. So they paid $0 on the tax prep. They went through whatever the free system on one of the, Intuit programs or something, but then they overpay by $100,000. See, the ignorance, the liability of that, just the ignorance tax, is so much bigger than what they saved, obviously. So this is
because how much would it have cost for a tax professional at that level?
Right, and here's these big liabilities. So the liabilities that are the biggest liabilities are myths. Myths like high risk equals high return. That's a myth. It's about a risk. You're in it for the long haul. Neglecting cash flow. Waiting. It takes money to make money. Yep. I got to reduce my expenses to have more money. Right? And so it's like, stop being resourceful. There's all these myths that actually become a liability. So their belief is reduce expenses to then take that reduced amount to put into their assets, and the assets are going to create zero. The assets are going to create zero cash flow because they're just going to stop there and they're not going to start adding more income. That's retirement planning 101. Reduce expenses so you can take 10% of your income to build a plan that you can't touch till 59 and a half.
Gotcha.
Here's the economic independence plan. Okay, we actually start with the balance sheet instead of the income statement. Okay, so this is why it's opposite. Assets versus liabilities. And the very first thing we do is we go to the lower half and say, what if we increase in your human life value will increase your property value? Where is it worth taking some money or time to grow yourself and then have that grow your assets? Now, we want these assets to be cash flowing assets, not ones that just stop. And with that cash flow, we're going to create more income. Okay, and now with this increased income, the goal is to have 100% of your expenses covered by cash flow from your assets that are not your job. That then means the income that comes from here is from your business or a job, and 100% can create new assets. So we're no longer going 10% to try to get 10% on our 10% and wait for 30 years. We're saying 10 years or less, 100% income covered by assets, which now means 100% of your active income grows your assets instead of 10%. Think about this as a 10 times advantage.
Yeah, geez.
100% of this income building your assets, those assets then cash flowing and putting more money into here. This is velocity.
Yeah.
Right? Like that's the deal.
The main idea behind cash flow is really more about kind of the life design element to a degree, right? It's reducing that stress.
Yeah, so part of it is this faulty life design is just the whole notion of retirement. Retirement was a brilliant idea during the industrial age. People are working themselves literally to death 7 days a week in physically demanding, excruciating jobs. And what's happening is their body's breaking down. And so retirement was, hey, let's create pensions, and then people have, an ability to kind of live a few years in the end. And so I get it. But when we had a different age come about, we're in a different technological age and an information and transformation age. So retirement's an outdated idea. Financial independence is my replacement. That's my replacement for retirement. Assets to create cash flow, and that equals financial independence, right?
Yeah.
So we want that cash flow. And so when you're there, you can swing for the fences with your vision. And then instead of waiting till you're retired to do the things you enjoy, plan along the way. Take smaller trips on a frequent basis. Have time off. Do those things that you love. Find time for hobbies, not just 7 days a week work. So you still have the energy and the zeal and excitement 20, 30, 40 years from now to continue to be productive. Again, if you're in a demanding blue-collar job that is going to kill you physically, you can't make it, then I get it. Retirement might be your option. But why not just replace it with financial independence?
Yeah.
And then do the things you love.
Obviously, this channel is more for entrepreneurs. So if I'm an entrepreneur, I have a business and I want to retire because the business is just killing me. What would be the thought there?
Well, you could, you're an entrepreneur, retire in the business. So it's pretty simple. 5 and 5. Every day go. What are 5 things I want to do more of? What are 5 things I want to do less of? And then say, where can I permanently delegate the things I don't want to do? So I'm only doing the things that I want and that I love. So the business is functioning in a very mature way without you. But then when you want to be in the business and you want to do things, it's a place for you to go create. So retire in the business, because I feel like when people are going, I'm building this business to sell it, they're probably in the wrong business.
Yeah.
They're probably doing the wrong things. And a lot of people are just chasing the money, and that's why they get involved in that. And other times they love their business at one time and then it relentlessly exhausts them because they're the bottleneck. They love it. They do too much. They don't, like, one of the greatest things I did for my business was summer in Italy. Because all of a sudden the team had to market without me. We had to build new operations and management to make it work. We had to grow people over the 18 months preparing for that so that they could speak in my stead. What happened was, it's like when a child leaves the house and all of a sudden they're figuring out how to become a man or a woman on their own and new levels of responsibility. Sometimes we are the helicopter parents of the business.
Yeah.
And when we're doing that, we are going to drive ourselves crazy and exhaust ourselves and want to retire. So you've got to build the business that you love by being intentional with your life design, by having time to do the things that you want to do, by having free days along the way, by making sure that you show up. And by the way, if you go on a long trip and you don't want to come back to the business, it's time for a new business or a revolution and a makeover for that business.
So let's kind of go back to what you started talking about at the beginning. Was you had this great conversation with one of the biggest, insurance firms.
Yeah.
That came as a result of some actions where you decided not to take a payment from, but instead you got an asset through that. Could you kind of walk us through that?
Okay, so the story behind the book, What Would the Rockefellers Do, is Michael Isom, who's my co-author, was getting leads from Wealth Factory, my old firm. And the person in charge of Wealth Factory, because I was the content creator, called me the chief wealth architect, the CEO, decided to stop sending leads without talking to me. And so that was a raw deal for Mike. And I'm like, Mike, why don't we write a book together? I'll get you on some stages. I think that'd be a better situation for you. So it was like, out of this pain came this new gain. Okay. Mm-hmm. And so at first, I put the book up on Amazon for $1,000, but we were giving it away from our website plus shipping. So you basically get it for like $10. Okay. So most people are coming to our website to get it. Nobody's buying it here. Now, part of it was I knew financial advisors would want this and didn't know if they were trained or certified or would do the right thing. And it turns out people that started getting that book, the majority did great things. Some started using really risky structures that actually destroy the philosophy of the book. So I just started having people send pictures of their clients reading the book, or people saying, man, I was able to do this because they read Rockefellers. They didn't understand this kind of stuff before. They never want to talk about it. Then they start asking better questions. So I was like, well, why don't I just create a licensing program with my book where they would now get a forward to the book if they were what's called whole life certified. So aligned in philosophy, trained properly, using the right things. And so I did the first 10 as just like a beta group, not $10, just 10 people. The first 10, they just did a one-time fee, and then they had a forward to the book. All the links in the book now point to their website, and they get access to all our legacy materials. And we had tested like people getting the book and scheduling appointments from the book for ourselves, and it was going really well. And I was like, we should just share this with other people. Well, these insurance companies need to approve it for compliance. And one of the biggest ones, biggest, oldest, best, they approved it. And so I had this guy that was wanting to license and even wanted to do stuff with me. And I was like, I just had this intuition. I'm like, I'm just going to go speak for him for free because he's going to be the advocate for this. So I fly to Dallas, speak at his kickoff. I charged $25,000 for a speech, but this time I was like, this is more collaborative, more like a strategic partnership. And he's the one that got it through and approved. Yeah. Because I showed up, I delivered tons of value. By the way, a bunch of his people were like, we want a license. What is it going to take? So they were motivated. And then, he's like introducing me to other big producers and other companies saying they love your book. They're going to try to get it approved. So he became like this advocate because I poured into him. He's poured me value, just keeps going. And so that was the process. And now people can basically, an agency can invest $35,000 plus a monthly, and they get 5 forwards for people that get certified. They get the certifications. They get all the tools and the marketing resources and training. And, he's like, I want to have you come speak at the home office. And we've just seen that this book has been super effective at the Rockefeller method where they get trust and insurance and do it properly. So it's like, yeah, I'm willing to take the extra time rather than just get the money immediately.
Yeah.
And it was a much bigger play. Actually, someone he introduced me to just hired me to come and speak in April, and they want a license, and they want me to talk about licensing. So yeah, collaboration.
Could you draw that out on that, asset liability chart and kind of what that process looked like and how we would see it visually?
Okay, so let's look at this. So let's say everything below this line is the human life value. Everything above this line is property value. Human life value is who you are as a person. It's all the intangibles that make tangible things, your brain power and knowledge. But like this table is property value. This mic's property value. So when I started writing the book, realize we actually have to take money. It creates a liability because we have editors, designers. I mean, there's printing because we self-publish. There's building the marketing funnels. I mean, there's a lot that goes into it before you ever make a dollar. But I took writing courses. I did all this stuff. So when I rewrote it, it was after working with AJ and investing with her to help me with the book, Disrupting Sacred Cows in the book Money Unmasked. But then I became a better writer. I went to Tucker Max's writing courses. So I invested to become a better writer. I invested to learn what it was like. And even going through the process of making Killing Sacred Cows a New York Times bestseller, I had to develop all this human life value because I didn't know how to write when I wrote Killing Sacred Cows, and I didn't understand the editing process, and I didn't know how to create the right flow, and I didn't know how to find my voice. So I started hiring coaches, right? And so I'm putting money into that. And so we're actually lowering the net worth initially. But now when there's a physical book, so I look at the book as like a piece, like an asset. I think we printed 10,000 copies right away, right? And we've sold hundreds of thousands of copies, so we don't make a lot per book. We keep it really affordable to get the message out there. So that book, though, has produced, I mean, hundreds of thousands of leads and millions of dollars.
Yeah. So not necessarily the book itself,
Yeah.
but
So think of it this way. We spent tens of thousands, right? The book itself made hundreds of thousands, and then it led to millions from the people that we got introduced to, the collaborations that we did, and the way that we were able to generate leads for everything else we did. So it's like, this is like 10x, 10x,
yeah.
right? Because now I put my best foot forward when I'm not even there. I've got people reading that I've never even met. I've got people introducing and referring through the book. And then I was like, look, this was all a B2C play. Like, we're helping out people with their finances.
Mm-hmm.
And when that takes off and it becomes exponential, and we find most people are ordering 100 copies because their insurance advisors handing it out, it was time to be B2B. How do we improve the industry? That was the question.
Yeah.
So then I had to go back through this and be like, okay, so, and how do we improve the industry? It's going to take time because we have compliance and things. But I was like, okay, we already have the book, but now the book needs to be written for a licensee, right? With a forward. So now we have the expense of writing the forward, building out systems and team. But now all of a sudden, instead of selling a book for $10, we're selling a agency licensing agreement for $35,000.
Yeah.
Because we're now improving the industry, and it's this exponential effect because one licensee is going to represent hundreds, if not thousands of clients. So I'm helping them because they have these liabilities, right? They're investing money in marketing. They're investing money in, their websites and technology. They're investing all sorts of time. I mean, there's all these kind of things. I'm going, writing a book takes an extraordinary amount of time and a lot of money. And we just get to help them skip that. And then they get to leverage the brand of the Rockefeller book, my brand, Michael's brand. And so it's a very collaborative effort. And again, we're going from, this will hopefully be another 10x thing, right? So 10 by 10 by 10. So we're not just scrimping and saving. We're not just hoarding and keeping it to ourselves. I used to run these study groups for financial advisors. And they would ask sometimes, like, why are you sharing all this? Why would you tell us all this? And I was like, well, I want to be a better speaker. And I just find that the more abundant I am, the more I tell you, the more people come up and share their best ideas too.
Yeah.
And what happened was, number one, they started doing joint work with me. So I ended up getting, I didn't even have to market. They just brought clients to me and we shared in the commissions back in those days. Two, they brought me the best tax ideas. They introduced me to their tax. I just was able to learn so much because I gave. And the more you give, the more you can get. And so where most people get trapped is that they are focused through their 30 years plus of career only on the income statement. Income versus expenses. And the notion is, how do I keep my expenses down and save more of my income? I'm saying, hey, look, let's start with your balance sheet. What assets do you already have? How do we capitalize those to create more income? What liabilities do you have? How do we manage those so they don't create too many expenses? And continue to increase your profit by having your assets cover all of your expenses and having your active income build more assets. It increases the exchange. It increases the velocity. It increases the possibility. And I have people that, I wrote a book with the guy, Nick, and he did this when he was young. And he's got so much wealth because he was financially independent early and could just reinvest. Justin Donald, lifestyle investor, I watch his explosion of being frugal enough to be financially independent and then get to a 2-to-1 ratio. And then he got much faster because he was able to have his asset cash flow create his lifestyle, not his active cash flow that he's creating by having to be there and work and do things day to day. So It's a total game changer. And look, every entrepreneur knows cash flow. Unfortunately, most retirement planners focus on accumulation. The thing is, everyone is going to have to master cash flow sometime in their life. Why not start building that muscle now?
Yeah,
it's kind of like if you go hunting and you shoot something, you've got the harvest.
Yeah.
But if you have a tree that continues to produce fruit, that's the flow. versus like, I've got to kill. Okay, now we're hungry. Got to go kill again.
Yeah, gotcha.
Yeah.
That's a great way to put it. Thank you for walking us
Thanks,
through that.
Weston. Little cash flow combo. I like it.